Hi everyone, my name is Mark Brinser. I am a certified financial planner with Stewardship Advisors, which is a fee-only financial planning firm here in Mount Joy, Pennsylvania. Over the last couple of months, I've been getting this question quite often from people as they have seen the advertisements that interest rates are at historic lows, and so they're often asking me, is now the appropriate time to refinance, and what are some of the things I should consider if I am looking to refinance? So for me, there's really three key points that I take a look at when anybody is considering a refinance. The first thing to look at is your new interest rate going to be at least 1% better than your old interest rate? If it's not going to be, then generally speaking, the second and third points that I look at are not going to make sense. So if the new interest rate is not going to be 1% better, you don't even really need to move on to the next 2 points. But if it is, then we move on to point 2, which is the break-even analysis. And basically a break-even analysis is just looking into how much time is it going to take you to recoup the cost of the closing. So in other words, when you do go into a refinance, there are going to be some closing costs associated with that, just like when you're buying the house for the first time. So if we look at a house refinance of about $300,000, we're just going to use a round easy number of $4,000 for your closing costs. Could be higher, could be lower, depending on your mortgage broker and what they charge. But that's going to be the cost of the refinance in our scenario of $4,000. So if your interest rate is going to go down by 1.25%, you're basically looking at saving $3,750 over the next year versus your closing costs of $4,000. And so what that break even shows us is that in the span of about 13 to 14 months, you will have saved enough in interest to offset the closing costs that you paid to refinance. That's a pretty good payback period. Anytime that you get a break-even analysis that shows payback period of 2 or less years, usually will make sense to go ahead and move forward with that refinance. Anytime that payback period is 4 or 5 years, that's when you need to consider if it's really going to be worth it over the long term, how long you're going to be in the house, those sorts of things. And then finally, the last point is we want to make sure that when you do refinance, it's going to, at the very least, lower your interest rates, but if it can, also shorten your time period and shorten the duration of your loan. As long as those two things are working together, then you've got 3 really good points of looking into refinancing. So again, general rule of thumb, 1% better than you're currently getting on the interest rate is a good place to start. Then do your break-even analysis, and then finally make sure it's going to hopefully shorten the time period of your loan as well. If you have any questions on that or want to look into your situation, don't hesitate to reach out. Thank you.